Some people have a fear of heights, some don't like the sight of blood, the fear of closed spaces, but I have what I call an phobia. It started in the year 2001 when I first came across something called the Black-Scholes option pricing model. You see, the model was developed. The formula is calculated by multiplying the stock price by the cumulative standard normal probability distribution function. सब ऊपर से निकल गया ना? So let's simplify it and we start with the most important question. Why would a retail investor want to use something so complicated? Well, look at it this way. Every video I have made so far on this channel has followed the traditional setup. We figure out how to identify undervalued stocks, we invest in them, we wait for the price to go up and eventually we make money out of it. Now, when it comes to futures and options, your possibilities expand because now you can make money when the market goes up, you can make money when it goes down, and you can also make money when the market is relatively flat. I guess that's the big incentive of participating in FNOs, and truth be told, I have never tried any of this, which essentially means I am in the majority, and this video is a start from scratch in every sense of the word. So let's learn together, and in this presentation I shall take you through my understanding of what exactly is a future and what is an option, how does it work, some examples, how one can make money from it, etc. This will pretty much be a beginner's video, and if you still find value from it, then do give it a thumbs up. Let's begin. Before we get into futures and options, let's understand what a derivative is. So this term derivative refers to a type of financial contract whose value is dependent on an underlying asset. For example, you might have heard of something called Nifty futures, which essentially is a derivative contract that gets its value from its underlying asset, which in this case happens to be the Nifty 50 index. In fact, if you're a Norman Lewis word power made easy fan, then derivative comes from the Latin word derivare, which means obtained from. And derivatives can obtain their value from any underlying asset, which includes a single stock, a Nifty 50 like index, a basket of commodities, houses, crude oil, fruits, vegetables, coffee, etc. Even gold actually, and the SGB, the sovereign gold bond that the Reserve Bank of India releases from time to time, is pretty much a derivative instrument that derives its value from the price of physical gold. So when the price of physical gold goes up, the price of an SGB also goes up and vice versa. Now, I've simplified this a bit, but this should not give you the impression that derivatives are a teeny-weeny bite-sized financial product. In fact, the derivatives market is huge, with crazy amounts of it being bought and sold on an everyday basis. I mean, look at it this way. So if this post-it note represents India's largest company and its $200 billion market cap, then this is how big the cryptocurrency market is. This is the world gold market, here's the global equity market by capitalization, the cumulative value of the world's real estate, and this is how big the global derivatives market is, $700 trillion, making it the biggest asset class in the world. So there are many types of derivatives, but specific to equities, there are 5 types of contracts: forwards, futures, options, warrants, and swaps. Now in our country, forwards, warrants and swaps are not that popular. So we'll focus on the other two, starting first with futures. So what is a futures contract? Well, A, it's a legal agreement as a contract should be. B, it relates to the purchase or sale of a physical asset or security. Number 3, it puts forth a predetermined price. And finally, it also specifies a time in the future. For example, Nestle sells a lot of coffee under its Nescafe brand, which costs us about 350 rupees per 100 grams. Now, understandably, Nestle cannot change the price of coffee on a daily, weekly, or even monthly basis, even though the price of its main raw material, the coffee beans, have been doubling, tripling, and halving over the last couple of years. And that's exactly where a futures contract comes in. You see, both parties, that is the coffee bean producer and Nestle, they both prefer a certain predictability in the price. And therefore, they would enter into a futures contract where someone like a Nestle might say, I, Nestle India, commit to purchase coffee beans from you at $100 per bag 3 months from now, irrespective of the market price, which can be higher or lower of the price that we have just agreed to. So effectively, both parties have locked in the price. Also notice no money has been exchanged here, except maybe some initial margin that the coffee bean producer might ask for to reduce the risk of non-payment. This is typically how a futures contract works, and we see a lot of this in agriculture, in energy products, metals, currencies, and of course in financial products like indices, bonds, ETFs, and stocks. In fact, let's see how this plays out in a trading platform. Now, I'm recording this video in the middle of March, and when I type in any stock, say ICICI Bank, I'm presented with three future options. ICICI Bank March futures contract, which is the current month, ICICI Bank April futures contract, and ICICI Bank May futures contract. Now remember the current month, that is March's future contract, and for that matter any month's future contract expires on the last Thursday of that month. And when the March one expires, a new futures contract for June will be added, and this 3-month, 3-contract sequence will continue. Now say I'm keen on the April futures contract, and as of this moment these are available at 845 rupees, while one share of ICICI Bank is currently priced at 836 rupees. This means whatever is the share price of ICICI Bank on the April futures expiry date, you will get these shares at 845 rupees only. This is the entire essence of this futures contract, that is, you make a contract for a future date and you're locking in the future price. Now the question is, how do you make money from this transaction? Well, it's a lot like how a stock transaction works. So if the price of the futures goes above 845 rupees, then you can sell it, or as the technical word goes, you can square off an existing position, make a profit from it, and similarly, if you sell it at a lower price than 845, you have to pay the piper and you will make a loss from this transaction. The other way to make or lose money is at the expiration of the futures contract itself. So on the day of futures expiry, if the spot price, that is the actual share price of ICICI Bank, goes up to say 870 rupees, then the futures will also go up to pretty much the same number, which means you make a profit from this transaction. And if the share price were to go down, then the situation reverses and you end up with a loss. More specifically on this, do go through some reading materials and resources I have added in the video's description, which I'm sure you'll find useful. The other thing one needs to understand about futures contract is the quantity, and unlike shares that you can buy as a single unit, futures have to be bought as a bunch of shares, which is also called a lot. If you're wondering why this is the case, then remember futures were never designed for retail investors, and by standardizing the lot size, the stock exchange tries to make it easier for traders to understand the futures pricing, the risk, and the cost of executing the trade. Now in the case of ICICI Bank, the current futures lot size is 700 shares. This used to be a lot higher, 1375, until November of last year, but it now stands at 700 shares. So 700 multiplied by 845 rupees gives us a total of 5,91,000 rupees. But the good thing is an investor doesn't have to pay 5.9 lakhs for buying a single lot of ICICI Bank futures. Instead, what one needs to pay is a partial amount, which is called a margin. So think of a margin like an advance amount, something I mentioned in the Nescafe example as well. And understandably, stock exchanges insist upon this to ensure the contracting party doesn't just run away without honoring his side of the transaction. So the margin amount listed here is 1,09,000 rupees, which comes to a little over 18% of the contract value, that is 18% of 5.9 lakhs. Now when you start looking at futures in your trading platform, you'll come across a few more terms like AMO, stop loss, intraday, cover order, market order, limit order, etc. If the response of this video is good, then I'll probably take those up as well in a different video. But if you want to dabble around with futures now, then please read about these terms before executing any trade, because some of these features like stop loss and others are very useful, especially when you are starting out. So a lot like what we saw here with ICICI Bank, one can find other stock futures like Reliance futures, Tata Steel, HDFC Bank futures, etc., which presently comes to a good 198 stocks whose futures and options are up for trading. In addition to stocks, there are the ever popular Nifty futures and also the Bank Nifty futures, which are traded in huge volumes on a daily basis. Alright, we now come to options, and let's go back to that Nestle and coffee bean producer example. So Nestle is keen on purchasing coffee beans from the producer worth 1 crore of rupees at 10,000 rupees a bag and within the next 2 months. Now remember, the price of coffee is very volatile due to weather, supply chain, demand, etc. And Nestle doesn't want price fluctuations to disturb its financials and operations. To that effect, Nestle now offers a token amount, say 5 lakh rupees, to the coffee bean producer, which virtually locks in the deal. In other words, this 5 lakh rupees is an options contract which, depending on the price of coffee, allows Nestle to be flexible with the next move. I'll explain this better, but just to define it, options are a type of financial derivatives that give its holder the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. In fact, when we get deeper into options trading, and not in this video but in another video, you'll hear the phrases call option and put option quite a bit, so let's understand that part. A call option is one where its buyer has the right but not the obligation to buy an agreed quantity of a particular commodity or financial instrument from the seller. It comes with a certain time window which ends on what is called the expiration date. The option is for a certain price called the strike price, and for that right, the buyer has to pay a small fee to the seller, which is called a premium. When we apply this in our coffee example, Nestle, who is the option buyer, had this right but not the obligation to buy coffee beans at the agreed price, that is 1 crore. Nestle could do that within 2 months, and for which it paid 5 lakh rupees to the option seller, that is the coffee bean producer. Now, what are the scenarios that could have been played out for Nestle? Firstly, the price of coffee could have gone up to 1.5 crores, which means Nestle would have definitely exercised its call option and purchased coffee beans at 1 crore, which saves them 45 lakhs. Number two, the price of coffee could have gone down to 70 lakhs, which means Nestle will not exercise the option. It'll simply walk away from the deal and buy the coffee beans at market price, which will save them 25 lakhs. The third scenario is where the price remains at 1 crore, in which case again the company will not exercise the option. In fact, graphically, this is how the entire transaction would look like, and one can see how this benefits Nestle in case the price of coffee beans were to go up or down. On the other hand, the coffee bean producer makes money from this transaction if the price were to stay at the same level, so it's not that he's getting a raw deal from it. I'm certain this coffee bean producer will be having option agreements of his own with seed providers, fertilizer companies, harvesters, etc., which means he is an options buyer with these companies and an option seller with Nestle. In essence, you can buy a call, sell a call, buy a put, and you can also sell a put. If you're wondering what a put is, then very simply, it's a call option in reverse. It effectively means the put options buyer is anticipating a fall in the price of the underlying asset and therefore wants to retain the right to sell it at a higher price until the date of expiry. So between buying and selling a call option or a put option, we have 4 foundational parts of any option strategy. From a stock market perspective, the option one wants to buy or sell will depend on your view of the market. For instance, if the investor is bullish on a particular stock or on the Nifty, then it's ideal to buy a call option, and if you are bearish, then one should sell a call option. Likewise, when you're buying a put option, then you are bearish, and if selling a put option, then you are bullish about that particular stock or the index. Okay, so if you've understood everything so far, then well done, because after 3 days of reading and researching, this was more or less the time when I started to feel a bit lost. I guess that's because it's a new topic and it'll take me a little more time to absorb and appreciate the inner workings of it. But I hope to be back with another video that has a few more insights, especially on the different ways in which one can trade in futures and options and the different strategies that one can employ. Until then, do share your feedbacks in the comment section, and I'll see you 3 days from now with an interesting video on how you can build a monopoly portfolio which has actually delivered a return of 27% in the last 5 years. So wait for it, and I'll see you then.